Chapter 8: Losses and Bad Debts. Losses on bad debts are transactions that are going to result in losses. Realization is prerequisite for taxable loss. Recognized equals taxable asset. Sale and exchange of property. In sale or exchange, amount of loss equals excess of property's adjusted basis over the amount realized. Losses incurred on a sale of personal use property aren't deductible. They're not deductible because intent was personal use. Losses on business use property are deductible. Under Section 145. Expropriated, seized, confiscated, or condemned property. Expropriated means foreign government taken. Seized means have taken loss in year of seizure. These give right to a deductible loss only if property is used for trade or business. Taken as a capital loss, losses on trade or business property, investment properties are deductible because they're for trade or business or for investment properties. Abandoned property, used in trade or business or held loss investment, gives rise to a deductible loss. Amount of loss is the adjusted basis equals date of abandoned. Character of loss is ordinary. Abandoned property equals ordinary loss. Demolition of property. Demolition costs are to be added to the basis, not expensed. Ordinary versus capital losses. Classification of a loss as ordinary or capital is dependent on type of property involved. Losses on qualified 1244 stock. 1244 stock is usually stock of closed corporations, which are small limited stockholders, usually family businesses. These losses are treated as ordinary losses. Limitations are 50,000 for married filing single head of household, and 100,000 for married filed jointly. Is not a capital loss. Do not offset 3,000 loss limitation on capital losses. To qualify as Section 1244 stock must be issued and owned by an individual for a partnership. The corporation must be a domestic corporation, no foreign corporation. Stock must be issued for cash or property contributed in lieu of stock issued, not services. The corporation must not have no more than 50%. Gross receipts from passive income sources. At time of the issue, the amount of money the property is both to capital and are additional paid in capital that may not exceed 1 million. 1244 election has to be on the Articles of Incorporation, Articles of Formation. Disallowance possibilities. Certain realized losses are disallowed in special situations. Related party transactions. The first level, family, parents, brothers, sisters, grandchildren, and nieces and nephews. Second level, stockholders who own more than 50% of Choice Corporation. Third level, general and limited partnerships. Passive losses. Passive loss definition. Passive activity includes any rental activity and any trade or business or investment activity where the taxpayer does not materially participate. Investment in a limited partnership could generate passive losses. In Texas, CP equals presuppose that you do not participate in management. Materially participation or manage equals automatically you become a general partner. Computation of passive losses and credits. Passive losses may only offset passive income, not portfolio income, stock, mutual funds, etc., or active income, salary, W-2, self-employed, Schedule C. Portfolio income, non-business dividends, interest, royalties, annuities, certain gains and losses, certain passive credit from passive activities are also limited. Credits on income tax return. Passive credit can only offset tax liability generated by passive income. Carryovers. Unrealized passive losses may be used against future passive income on the disposition of the passive activity interest. The carryover is unlimited amount and duration. Taxpayers subject to passive loss rules applies to individual estates, equal pass-throughs, trust, simple trust, equal pass-throughs, complex trust, not a pass-through entity, personal service corps, closely held C corporation, traded partnerships, publicly traded parties are usually subject to pass-through. Real estate business. Certain real estate professionals who materially participate in real estate activities will not be subject to passive loss and limitations. Material participation for the exclusion: 1. Perform more than half of the taxpayer's personal service in real property trades or businesses. 2. Perform more than 150 hours of service during the taxable year. The exception is other rental real estate activities. Other rental real estate activities, 25K exception to the passive loss rules. Actively participating in real estate activities. The rules are: 1. Must have at least 10% of the activity must fit the 12-year rule for the entire and must be for the whole tax year. 2. Has to have AGI less than 100K. Individuals who otherwise qualify must reduce 25K exception for 50% of the excess AGI over 100K. Individual has a rental real estate qualifying for passive loss of 25K. Casualty and theft loss. Deduction for personal casualty loss, theft loss must be federally declared disaster. Casualty and theft loss of business and investment property are always deductible. Casualty defined. Casualty loss results from an identifiable event that was sudden, unexpected, unusual, not foreseeable. Qualifying casualties are fire, flood, hurricane, tornado, hail, and cyclone. Theft defined. Criminal intent equals desire, purpose, mens res, which equals mental state to become criminal. Actus res, acted on mens res or mental state. Violation of state federal law, and for tax purposes, larceny equals criminal intent. Larceny equals criminal intent to remove property to deprive the owner of that property. Embezzlement, criminal intent, remove property, fiduciary relationship, deprive owner of that property. Robbery, criminal intent, removing property to deprive the owner with instrumentality or placing person in fear. Also, blackmail, extortion, and ransom are theft. Deductible amount of casualty loss. Reductible amount of personal use property and a partial destruction of business property is the lesser of fair market value or adjustable basis. Even if negligent, can still be counted as casualty. Netting casualty gains and losses on personal use property. Gains or losses on personal use property are netted separately from gains and losses on business use property. Personal casualty losses that don't result from a federally discovered disaster are deductible to the extent of personal casualty gains for the year. Personal use property casualty loss are subject to 2 reductions. 1. Each separate casualty is reduced by $100. 2. Total of all personal casualty are reduced by 10% of Judgment Bureau's income. Bad debt. Must be bona fide debtor-creditor relationship. Support of bad debt deduction underlying bad debt must be validated and enforceable. Must have a determined sum of money. Taxpayer basis in debt. Creditor must have basis in the debt for the bad debt to be deductible. Must have valid consolidator. Debt must be worthless. Must demonstrate the debt is worthless. Bankruptcy equals unsecured. Disappearance, lack of payment for a year or more, or non-business bad debt equals non-bad Non-business bad debt equals short-term capital loss. Business bad debt. Partially or totally worthless business debts are deductible as ordinary loss. Accounting for the business debt, we can only use the specific write-off method, mandatory for tax purposes, even though allowance method is for GAAP, financial statement purposes. Recovery of bad debts, previously written off in income in the year received. Deposits in insolvent financial institutions. Qualified individuals can elect to treat deposits in an insolvent institution as a personal casualty loss. A net operating loss generally involves business income and deductions only. Deductible casualty and theft losses will increase net operating losses. Computing NOL. Several adjustments are necessary to taxable income or loss to reach NOL. Adjustments include adding back any prior year NOL deductions, certain capital loss adjustments, or any excess of non-business deduction over non-business income. Carryover periods. NOL after December 31st, 2017 are allowed to be carried forward indefinitely with no carryback. NOL carry-forward deduction in a subsequent year is limited to 10% of taxable income before any NOL reduction. Classification and limitations of the employee expenses. Nature of the employment relationship. Serious tax consequences that flow from the characterization of a taxpayer or employee. Employee versus independent contractor are payroll taxes and reporting of income. A self-employed individual will be responsible for the self-employment tax, Social Security, and Medicare, which is much higher than what a common law taxpayer pays. Taxpayer is considered an employee if has the right to direct and control the end result and the way result is accomplished. For FICA, 6.2%, Medicare, 1.5%, that's for the employee. For employer, 6.2% Social Security, 1.45% Medicare. Limitations on unreimbursed employee expenses. Prior to 2018, unreimbursed employee expenses were classified as miscellaneous deductions. 2% reductions of AGI and TCJA changed that. No miscellaneous deductions. Travel expense. Deductibility of travel expenses is dependent on the nature of the expenditure and whether the employee is reimbursed. Travel for self-employed individuals are fully reimbursed travel expenses and are deductible for AGI. Prior to 2018, unreimbursed employee travel, whether there was sufficient or no reimbursement, were deducted as miscellaneous deductions subject to the 2% floor prior. Always go to employer who has accountable reimbursement plan. Definition of travel expenses. Travel includes transportation, meals, lodging related to trade or business, employee status while away from home. The deductibility amount of travel expense may be reduced if lavish and extravagant equals objective standard equals reasonable person test. General qualification requirements. Travel expenses related to travel, or trade or business, or employee status while away from the taxpayer's home. Transportation costs for day trips even though the taxpayer does not stay away from home overnight. Travel expenses always depend on domicile. Business versus pleasure. Travel expenses on combination business trips will only be deductible if the domestic trip is primarily business to and from the business and are deductible even though there is some personal time. Expenses for personal days will not be deductible. No deduction is allowed for the travel expenses of a companion unless the companion is also an employee and travel is business related and otherwise deductible. More stringent allocation rules for foreign travel. Transportation. Definitions and classification. Commuting costs are usually non-deductible and personal expenses. Prior to 2018, TCJA commuting costs between multiple jobs, transportation costs from employees, regular place of work and temporary job site, and from home to temporary work site were deductible as miscellaneous deductions in the limited to 2% AGI. Treatment of automobile expenses. Actual business automotive expenses can be deducted, or we can take standard mileage, which is 20 after 20 since as of 2018, 54.5 cents per mile. This also covers maintenance, fuel, licenses and taxes, insurance, tolls and parking, depreciation. For newer cars, the deduction of actual expenses will generally exceed standard mileage deduction. Reimbursement of automobile expenses. Prior to 2018, employee could deduct actual automobile expenses in excess of an employer reimbursement miscellaneous deduction, which was subject to the 2% floor. Entertainment expenses. Prior to 2018, entertainment expenses had to meet directly related and associated work with, for trade or business, and generally deductible. TCJA got rid of because of abuse. Taxpayer can still deduct meals directly related or associated with at the 50% deduction. Self-employed individuals employees who are fully reimbursed may deduct entertainment expenses for AGI. Unreimbursed employee entertainment expense deductible uses miscellaneous itemized deduction and subject to a 5% floor. Classification of expenses. Entertainment expenses must be directly related to business activity or associated with business activity to be deductible. Directly related expenses expected to be deducted except for goodwill. Associated with must have clear business purpose obtaining new business or keep existing business. Under Section 274, substantiations are very strict. Business meals are also meet the directly related or associated with test to be deducted. Deduction portion of any business meal does not include any lavish or extravagant component. This is objective and standard to the reasonable person test. Entertainment facilities and club dues. Generally, no deduction is allowed for the costs incurred to maintain entertainment facilities, which include yachts and hunting lodges. Entertainment facilities provided for employees, such as swimming pools or golf courses, are excluded from this rule. No portion of country club due is deductible. Business gifts. Generally, deductible business gifts are limited to $2,500. Limitations on entertainment tickets limited to 50% of ticket's base value. Your own ticket cannot be deducted, and skyboxes. Any expenses in skyboxes are not deductible. Reimbursed business expenses. If we are under an accountable plan, reimbursements are excluded from employees' gross income. Expenses are deducted by employer nets the deduction. Non-accountable plan reimbursement are included in gross income. Expenses are deductible as miscellaneous deductions, but still open to 2% floor and 50% deductions. Accountable plans are better than deductions. Moving expenses. Education expenses are deductible if they maintain or improve skills in employment, meet the legal or employer requirement for retention of employment, qualify for a new job or new trade or business, equals education expenses are disallowed. Office and home expenses. Minimum requirement for home office deduction include exclusive use on regular basis as principal place of business, such as meeting with clients, patients, and customers. Prior to 2018 had to be convenience of employer TCJA has suspended all miscellaneous deductions. Self-employed individuals can take this for AGI. If you have home office and have to go to work office one time a week, you automatically don't get a deduction. Depreciation office at home if sold. If home office depreciation of home office and then sold, now treated as a capital gain. Deferred compensation, qualified pension and profit sharing plan. Deferred contribution plan equals employer put money in and there's no treatment. Defined benefit plan equals actuarial based. When you die, money goes back in pool. 403(b) organization and government. 401(k) corporate. Contributions to a qualified plan are deductible by the employer. Accumulated income are not taxable until the employee receives it. Pre-tax equals taxable when you are vested or receiving benefit. Post-tax, not taxable when you are vested, but now only income is taxable. Employee contribution are always taxable to the employee. Traditional IRAs. Fully deductible IRA contribution, lesser of $5,500 or earned income. Only available to two groups of taxpayers. 1. Taxpayers who are not active participants in a qualified employee plan. 2. Taxpayers who are active participant but their AGI is less than $63K for single, $105K married filed jointly. Partial deductions are available to the active participants for AGI less than $73K for single or $121K married filed jointly. This deduction is phased out over the $10K AGI range for single and $20K for married filed joint. A non-working spouse may contribute under the 5500 plan. Roth IRA, no deduction for AGI, earnings are non-taxable, phase out on AGI levels at 120K to 135K AGI for single, and then 189K to 199K for married filed jointly. Depreciation cost recovery. Required to do consistent basis, adjusted basis equals the asset minus depreciation. MACRS equals double declining balance, which leads to timing issues sometimes with GAAP. Depreciable basis of property converted from personal use to business use equals adjusted basement or fair market value. Depreciation method. Most personal property for 3, 5, 7 useful life is MACRS with no salvage value. 200% double declining balance can convert to straight line. Residential rental property equals 27 years. Real property equals building 39-year period. Section 179, which is for new and used property. 2018 taxpayer may elect to expense up to $1 million a year qualifying tangible personal property. Exceeds $2.5 million equals lose $1 per every potential Section 179 expensing of every $1,000 of qualifying. Bonus depreciation is only for new property. 100% bonus depreciation on qualifying personal property placed into series as of 9/27/19. Section 179 first, bonus depreciation, then MACRS. Presuppose all Section 179 and bonus is recaptured if we don't keep the asset. MACRS restrictions. MACRS does exist for some personal property. Listed property and luxury automobiles. Portion of the asset's cost related to personal use is not depreciable. Business usage of an asset is 50% or less. If business usage of an asset is 50% or less, you have to use the alternative depreciation system. For the test, alternative depreciation system is straight line. Personal automobiles are subject to a limitation on the annual MACRS deduction. Adjustment if personal automobile is leased. Restriction on luxury vehicles. Amortization of intangibles. Goodwill is either purchase company. Acquired goodwill is purchasing a company on a stock sale or an asset sale. Non-acquired goodwill equals mergers when moving assets over or usually on equity method. Intangibles we amortize using straight line method. Examples of Section 197 intangibles subject to a 15-year amortization such as acquired goodwill, licenses, covenants to compete, customer lists. If covenant to compete is for 5 years, we still use 15-year amortization. Classification and disposition of intangible asset. For gain purposes or disposition of Section 197, treated under depreciation capture rules 1245 and 1250, a loss is not recognized if other intangibles from the same acquisition are retained. Loss will be added to the basis equaling of the remaining intangible assets. Research and experimental expenditures. Research and experimental expenditures. Research expenditures may be deducted currently. They may be deferred and amortized over 60 months. If it is capitalized, then we can just write it off. Computer software, if it's taxpayer development, it's considered research and development, which can be amortized. If it's acquired computer software, we capitalize it. Lease of Microsoft Words can be written off. Depletion, intangible drilling, and development costs can use cost depletion or percentage depletion. For depletion, we take the royalties plus 15%, may not exceed 50% of taxable income from property before depletion. Costs, adjusted basis of the asset divided by the estimate recoverable units to arrive at per unit depletion cost. Per unit cost is then multiplied by the number of units sold to determine cost depletion deduction. Two ways to handle. If it's capitalized, we are taking the amount added to property basis, deducted currently as an expense. If capitalized it, we do it over the life of the well. If it is a non-producing well, it is considered to be an ordinary loss.